Much for joining us.
No, pleasure.
From the early hours of this morning, I mean, you were telling us that you were suffering from insomnia, and we quickly sort of jumped onto it. This is worrying, isn't it?
No, it is worrying, but I think we need to always appreciate that you can have external events as a trigger for something that's probably overdue, but our markets are overextended. The all-share index has been on a tear for the last few years and hitting new highs, etc., and it has become expensive. So you can get a trigger like Greece and China, but the actual overall fundamentals are still embedded in our own market. And so South Africa is vulnerable because we have a deficit with the rest of the world. We're building up our liabilities towards the rest of the world. So when something happens in the rest of the world and it's debt-related, people look there, but there's a trend here that's very similar, even though we're at much healthier levels. The actual trend is not in the right direction.
Yeah, let's just get to. We've been focusing so much on Greece. China's almost jumped up on top of us now. So I think we need to get an understanding of what's actually going on there. I've seen so many explanations that, if I can be honest with you, I don't understand. And if I don't understand it, I think a lot of people don't understand. What is happening in China?
Well, Greece and China are unrelated, but they have the same root cause, and that is too much debt. So Greece has been borrowing money to meet welfare commitments for quite a long time. Nice early retirements, nice high pensions, all of that are more generous than, say, the rest of Europe. And China, on the other hand, in response to the 2008 global financial crisis, they really cranked up the printing presses. They'd had quantitative easing, in spades, and their debt levels have virtually quadrupled. And you could see the amount of speculative money, like moving into property, for instance. Now, that bubble started to burst last year already, and then you saw a switch, more or less at that time, into equities, and equities shot up also into bubble territory. In other words, a huge rise over a short period of time. Now that's starting to unwind, and you've got the authorities now. How do you unpop or try and blow up a bubble that is bursting? It's like if you pop a balloon, how do you undo the pop? It's not easy, and it's basically I saw a very good explanation is often when you see a bubble bursting, you say so much value has been destroyed by the markets falling. And the comment was that all a bubble bursting is repricing assets where you've already had the loss in malinvestment. In other words, the loss is there, it's just now being repriced to reflect that loss. And that's the problem when you have cheap money that needs a place to go. Interest rates do two things. One, it does affect the cost of capital, but it also affects the quality of how you allocate that capital. So when it's too low, you get the phenomenon that you have in China of borrowed capital allocated badly, whereas high interest rates tend to boost the savers. You then have saved capital allocated well. All right, and that's basically the big difference. And I think if we have a look at the way crises have been unfolding, the emerging market crisis of 1997, 98, in other words, quite a while ago, that was an interesting time because that again was deficits, growth running away too quickly. The solution, very controversial at the time, was to raise interest rates, cut back government expenditures on other unsustainable things like subsidies and bloated civil servants. And that always exacerbates a crisis at the time, but the recovery trajectory was remarkably strong, robust and enduring. Whereas the developed world has done exactly the opposite. They've cut interest rates, flooded their system with liquidity, and expanded government expenditure. And they are still struggling, 8 years on from their crisis. And that's starting to tell you which is the right medicine. And the right medicine sometimes is very harsh in the short term, but may well be that you raise rates. In other words, restore the balance to savers, because it's savings that funds the growth that you're after. Low interest rates,
reward
damaging,
saving, not spending.
Yeah.
But what we've seen happening now, and just to sort of wrap up the conversation, South Africa now forming this bank with the BRICS, with BRICS, and this is obviously China very much so involved. So we are exceptionally exposed to them, our biggest trading partner. The euro, we track the euro quite closely as well as our currency, and we see the euro on the back of what's happening in Greece. So South Africa is certainly getting a lot of repercussions from what's happening around the world. Where does this leave us? I mean, where to from here for us?
Well, the new development bank is a strain on South Africa. We all have to capitalise it. All the BRICS have to capitalise it. For China, it's small change. For Brazil, it's small change. Yeah. For South Africa, it's a big chunk of money.
What are we talking?
When we're sitting? Well, I think the overall is they want to capitalise it to the tune of something $100 billion ultimately, with the fifth each, etc.
Each country has to contribute equally.
Kick in their contribution, and that makes it very difficult for South Africa. So that's going to stretch our ability to meet that obligation. Obviously, it comes out of things like foreign exchange reserves, but we're still struggling with growth. Right, because of deficits, and I think the focus on infrastructure may well be erroneous, because it's actually investment, not infrastructure. Obviously, is important. I'm not saying it isn't, but basically, it's investment in business and business activity that generates jobs and growth over the longer term, and we're not doing that. We're cutting back in that area. And that's where we need to change.
Yeah, which is going to have an effect on us. And listen, thank you. I mean, it's a day conversation we need to have here, Chris Hart. Thank you so much for giving us a little bit of background as to what is happening. Chris Hart, Chief Strategist at Investment Solutions, talking to us about the situation in China, where we're seeing 500 shares stopping, or companies stopping trading in their shares, and markets dropping there over 8% on Chinese markets. And now, of course, the situation in Greece as well, which is fueling Europe to drop lower. And, of course, South African currencies and our markets not looking too good as well. So keep your eye on the economy. All right.